Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Welcome back. Welcome back. It's interesting. I mean, that's all I really have to say. The markets were down quite a bit on Friday, but it's pretty normal. They've been on a slight downward trajectory, which is just how stocks behave. That's one of the things I was so naive. I think when I started this radio program back in 1996, I thought that at some point in time, everybody's going to get this. And what I didn't realize was that everybody is changing every year. Every year you get a year older. Every year a whole bunch of people pass away. A whole bunch of people graduate college. They move up into a second job or a third job and gain experience. So reality is, I guess the information's still got to be passed on somehow. And I just thought it would be, well, because it is available. I mean, almost anything you can think of is available today. But having the time to sit down and go through it and practice it, and there's a lot to know about finances. Investing is a big one. And so anyway, I was just surprised. I'm not even sure why those thoughts came up the way they did. But so anyway, I was talking to guy's got his first good job. He's looking to put money away and starting a plan. He's actually an independent contractor, so that means he can set up a solo 401k plan if he would like to. Those are really nice. You can put a lot of money away and deduct it off your taxes, so that's a nice thing. You can invest it any way you want. The vast majority of the firms that I use for that don't charge you to open it. They don't charge you for the documents. The ongoing annual maintenance, I think it's $0 now, which is pretty nice. It makes it a lot easier on everybody. So, if you're out there, you're self-employed, you can do those sorts of things. That's pretty good. If you got a side hustle, you can do those sorts of things. So the side hustle is a really popular phrase now. You hear it all over the internet. And basically what it means is you've got a side business. More often than not, they're referring to a business that might be over the internet. So just thought that was, it's just amazing how much stuff is going on. And I look at where we are today, as an economy. And, normally I take the first 15 minutes and just talk about the economy in general. The next 15 minutes we'll talk about fixed or guaranteed rates of return. There's not a lot to talk about there in the bonds or CDs, but there are other areas. And then the last 15 minutes, we'll actually talk about some individual stocks and see how that goes. So if you have a phone call or question, you can always call me, 216-901-0945, 216-901-0945. That's the number here at the station. I'm here live today. So feel free to give us a call and ask any questions that you'd like. If I can answer them, I will. If I won't, I'll write it down. I'll get back to you. That's another thing about our industry. it's kind of like the Internal Revenue Code. It's why I don't ever want to be a tax preparer. I have to know something about taxes. I don't have to know a lot. And I know enough to know that I don't want to be, that's not the career I would have chosen. And an awful lot of people confuse it with investing. And I get it. It's both financial. There's financial things. And a lot of the financials, you need to be able to read an income statement, at least some financial statements, to be able to evaluate a company. But that's a long way from doing their tax return. Anyway, not the same, kind of closely related, kind of like a doctors. The doctors tend to specialize, and then you have a generalist who will refer you to a specialist. And that's kind of how we work as a financial advisor. We're kind of a generalist. You got to know a little bit about a whole lot of stuff, and you have to be able to recognize when you need to refer somebody to a professional in that specializes in that. So whether it's taxes, estate planning, insurance, those are three separate vocations. They're all kind of related to what we do. And it's one of our jobs to be able to recognize when we need to, where we need to point you in what direction. And anyway, I've got to take a phone call, and Wayne's calling in this morning. Wayne, how you doing?
I'm fantastic. How about yourself?
Pretty good.
What's your opinion of putting money into BDCs versus CEFs?
BDC. You want to go ahead and define that for me?
Business development corporations.
Okay. Versus
and CEFs are closed-end funds.
So the business development corporation, now that you said that, it just jogged my memory. There are tons and tons of different kinds. And the closed-end funds, really like a mutual fund, but the price, the share of the price of the fund can fluctuate, and it can actually be selling for more than the underlying assets are worth, or it could be selling for less than the underlying assets are worth. That's why most people, they've fallen in popularity, ever since the ETFs first started rolling out. And I really don't. I'd have to look at the specific product or the investments in those funds to be able to give you a good opinion. There's no way, to look at from an investment standpoint unless you know what they're invested in.
Okay, all right. You suggest studying where they got their money and then making the decision there.
Yeah. Yes. Exactly. You need to look up the prospectus on there. It'll tell you how they're investing the money, or their quarterly reports. You can go in oftentimes and pull up the holdings if you want to go to the SEC's website, and that'll give you a really good idea. And actually, that's a good idea anyway, because sometimes funds will say this is what we're going to do, and then you look up the holdings and you're like, hey, wait a minute, that is not what you said you're going to do. Oh yeah, we changed. So yeah, that one of the things I really like about what I do is the level of transparency. I've got this fancy Morningstar edition. It costs like $1,000 a month. And it allows me to go in and pull up all the holdings of any fund. And I can see every single one of them. So I can kind of see when I'm looking for something, oftentimes the name might make you think that it's doing something that it's actually not doing. And so that gives me that's a big, big benefit. And it's by the way, I get these questions a lot, and I just had a guy ask, he wants to invest in energy stocks, and I look at the price to sales ratios, price to earnings ratios on the energy stocks, and I go, yeah, I can see why he wants to do that. It's because statistically they're cheap, okay, relative to their long-term averages in the stock market in general. So I'm like, okay. And then I'm looking at the holdings, and I can go down really quickly, look at some of the financial statements on some of those top holdings. And by the way, all this, the stuff that I've talked about so far, it takes about an hour. It takes it, and I've been doing it for 30 years.
All right.
So if it's going to take me an hour, somebody that's not, that hasn't practiced for quite a while, it's probably going to take a little bit longer than that. And that's where people have a tendency to get in trouble, is they get tired of doing the research, and a lot of them will just go, I'll just go ahead and invest in it. Well, I'm not sure I would ever do that. In fact, I'm absolutely absolutely sure I would not do that because, in fact, when I first started in the business, the industry that I'm in, I'm a registered investment advisor. We're a percentage of assets, not a commission in most cases, like 99% of the time. And that didn't even exist back in those days. And oftentimes, you're sitting up there falling asleep trying to read through a prospectus, trying to find out what they're actually supposed to be doing with the money. And then if you can get the reports, back in those days, the reports were actually about 90 days old already. And it's just a lot of work. I mean, that's the bottom line. It was a lot of work. And I know a lot of people just, roll the dice. And if they get lucky, I hope they get lucky, because when you're not,
All right. Well, thank you very much.
All right. Well, thanks for calling, Wayne. Have a good weekend.
You do the same. Bye-bye.
Bye-bye. Yeah, it can be really tough. And I'm talking to younger people now. You guys have a huge advantage. One of the disadvantages that you have is that, right now, is that stock prices are kind of elevated. They're higher than they really should be in a lot of the categories, not all of them. The large cap in particular, like the S&P 500, the valuations on those top stocks that make up the majority of that index are really high. And if the economic growth slows down significantly for 1 or 2 years, you're going to see the market cut in half. I mean, it'll go down 50%. And what's really wild is I keep forgetting until I look and I see my reflection in the glass in the radio station and see how gray and thin my hair is. I forget when I was your age and we were in the stock market. But I knew the stock market was overvalued in 2002. And at that point in time, you had CDs that were paying 5 or 6%. Big difference. You had real estate investment trusts that were paying 10 to 11%, the high quality ones, not the garbage. Okay. You had high yield bonds, the high yield bond index, the index including all high yield bonds was paying right around 11. And today those numbers are less than half of that. So my point is that we don't have as many places to turn. So you've got to be really careful today. You got to be really careful at how you're investing. Do you have a strategy in place? Are you fairly comfortable with that strategy? And I'm working right now. Actually, we're always working to try to touch base with our clients, just to try to go over that kind of stuff. And if you're hearing this and I haven't gotten to you yet, you are on the list. And it's tough. Try to get a hold of three of your good friends in one day. Try that sometime. Yeah. Now try to get a hold of 5 of them. It's pretty difficult. So, but we are, and it's just so important that you have a strategy. And it's not predicting where the market's going to be. That's not a good strategy. And I feel bad because I'm talking to this young kid. He's in his mid-20s and he's got his first real good job. So excited. And somebody told him that stocks average 10% a year, and that if you put $10,000 in there, it's $11,000 in a year, and then you put another $1,000 in there, and then you're going to make another 10% on that. Somebody told him this that he trusts, and that's actually not how the stock market works. The stock market goes up and down a lot, like a lot. You can be down 40 or 50%, and that's normal. That's absolutely normal. That's happened. It doesn't happen that frequently, but it's happened at least 4 times in my life. So, I mean, how many times, how old are you? If you're in your 40s, I wouldn't worry about it. If you're past the age of 55, I'd probably be a little bit more careful as to how much money that you have in stock funds. And today you can do a lot of things that we couldn't do 15 years ago. 15 years ago, 3/4 of the funds that have come out, of exchange traded funds, did not exist. Think about that for a second. And it does make it easier if you know what you're doing. If you can go through a financial statement, you have a pretty good idea. You don't have to be an expert, by the way. There are certain things you do want to look for. You don't have to know what every line means. I promise you. And in fact, that's another whole story, but maybe we'll come back to that in a future show. But you need to be fairly adept. Sales, profit margins. The amount of cash that's in treasury. The how much. Once you get past those numbers, by the way, everything starts to get a little bit iffier. You're relying on financial people that work at the companies to do estimates, and that's fine. But you have to understand, an estimate is an educated guess, and so there are only a handful of things that you can actually really know for sure, and it's very helpful. And in fact, I ran this illustration, and if you want a copy of this illustration I'm about to talk about, feel free to either send me an email, call. We have a 5-minute phone chat. I can send it out to you. Okay, I just can't send it out to the general public. I can't blast it out like that. I don't have the license to do that. But if I'm talking to you, you're a prospective, you're thinking about investing with me or anybody else, then we can have a conversation. I can get this to you. If you're a client, let me get this to you. I built a model. I call it the DOL model, Department of Labor model. A few years ago, the Department of Labor came out with a bunch of rules as far as how you're supposed to diversify. Now, they didn't tell you exactly how you had to invest, which is really kind of wild, because they said, okay, you guys need to be careful, and here's some general guidelines. And when we come back with questions, they go, oh, no, we're not answering that. Are you kidding me? So that's the kind of that's the kind of direction we've gotten from the government. Anyway, I built a model that I felt like would comply with that, and it's done well. It's got large, medium, small cap, international, emerging markets. It's got everything in there. And over the past couple of years, they've kind of loosened up and clarified a little bit on some of that stuff. So it's gotten a little bit easier, and I think it's going to help. I really do. I think you can put together. I've got a model right now. It's a little simpler. They're within 1% of each other. Basically within 1% of each other. The biggest difference is the newer model has slightly fewer funds in it. That's really the biggest difference. And actually, it may be a little bit less expensive, maybe 0.1% or so. But if you're dealing with billions, that's meaningful. If you're not dealing with millions, it's not that meaningful. So it's not a huge break out there. But anyway, I hear the music. That means this first segment's already over. You're listening to Bill Bullington right here on 1420. Stay tuned, because I'll be right back.
See.
And we're back. Hey, you're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon. If you'd like to reach out to us and have us do some work for you, some simple financial planning, feel free to give us a call, 330-664-0700. That's my office line. You can go to bullingtoncapital.com. That's probably the easiest, the best way to reach out to us. There's a little contact us form there, and we'll be glad to see what we can do. I'm constantly testing out new software to see if somebody comes up with a really good idea that's better than one of the ones I'm using. And that's been pretty interesting. Over the past, a couple of years, there have been a lot of modifications. I'm really excited to start trying one of them that has just come out, because I know the company that does it, and I think it might be, and maybe it's the real deal. The bottom line is, it's not that hard. I just feel so bad for people when they get into that. When you hear somebody talk about a financial planner, The very first thing they want to do is to have you go through a budget, which is incredibly important. But doing one is not that easy. I mean, have you ever sat down and done a budget, try to figure out and track every dime of every month, all your pay? It's pretty hard. So, and that's called cash flow financial planning. You're basically looking at the cash flow and giving every dollar a job. I've heard all that kind of stuff. I like the other type where you set a goal, and that's called goal-based financial planning. Hey, I need approximately this much income. How would I know that? Well, I actually did sit down and do a general budget for a month. And I figured out how much I have to spend. What do I absolutely have to spend on the things like food, gas, natural gas, electricity, water bill, whatever, your rent or your taxes on the real estate, all that stuff. What are the things that you have to spend money on? Okay. And once you have those, you can just divide that number. Actually, I shouldn't say that. It depends on your age. I use some software today that comes from a really huge firm that's actually the largest asset manager on the planet. And they give you this thing. It's called a glide path, or some people call it a glide path. It basically, you put your age in there and the amount of assets you have and any sources of income that you might have, and it'll give you an estimate of the sustainable withdrawal rate. So that makes it just really easy. I give an example. Let's say I'm, 67 years old. I've got $1 million. And I want to know how much I should be taking out. So you just put the numbers in there, and it'll tell you based on the type of portfolio you have. So it starts off at conservative. You can go moderate. You can go aggressive, and it'll give you an estimate depending on what kind of investor you are and the amount of money you have and the age that you are. So that's pretty slick, and that takes not much time. So that's one of the things I'm working on this year, first half of this year, is writing down a lot of this stuff. I'll start to publish it out on my blog, on my website, just to make this stuff easier. Because financial planning does not have to be that hard or complicated. Every time I hear so much stuff, it's really frustrating to hear about all the things that you should be watching and taking care of. Yeah, it's called life. But it is important that you have a general idea of, it should be within a few $100s or so of what your basic necessities are. And once you have that number down, you've got to figure out what you're going to get from Social Security or any pensions you might have. And then how much in assets do you have today? What are you saving? Are you adding to it? What kind of portfolio you're going to run? All that stuff. It actually takes, literally, when you have the information on savings and expenses, it only takes about 5 minutes to put that together in the software. So that's cool. I'm going to try to bring that out as much as possible this year, and this won't be the last time we talk about it. I like to keep things as simple as humanly possible, and I get that from my father's side of the family. That's how he was. And that's a lot of his people were. And these are personality traits that people are born with. I've come to realize that over the past 30 some odd years or so. People have certain personality traits. And there's a reason people like to do cash flow based planning. And I'm telling you, that is really hard. It's a lot of work. There's actually a guy that does the planning here. He's on the estate planning team. That's what he does, the cash flow type planning. Very tedious, and it's a lot of work. So my hat's off to him. I found a way that I like that's a lot simpler, and it goes along with my personality. And to each his own. That's what I have to say. But if you want to get a general snapshot, it's so much easier for me to generate that idea in a few minutes than it is to take a long time. So I'm going to leave that alone. Just know that if you're interested in seeing one of those reports, you can also call and we'll set up a phone call. There's no cost or anything to doing it. You'll do most of the work, and I can punch the numbers into the software. That it takes, like I said, about maybe 15 to 30 minutes, somewhere around there. And then it'll spit out the reports, and you have a really good idea of what a reasonable range of incomes you could expect based on how much money you've saved and all that other stuff. So, having said that, one of the things that is kind of unique to the economic situation that we're in today in this country is that interest rates are really, really low. They keep threatening to raise interest rates. I'm not sure that they're going to be able to raise them a lot. Rates have gone up a little bit over the past few weeks. A 10-year Treasury now is paying 1.7. That's up quite a bit from where it was off of its lows. A 1-year bill, Treasury bill, is paying 0.548. 0.548%. A 2-year Treasury note is now paying 1.016, 1%. Okay, a 5-year note's paying 1.5, which is actually, that's up about 0.5% or so from where it was, maybe a little over a year ago. But 1.5% on $1 million, okay, is $15,000. So you'd have to have $1 million in an account to generate $15,000. By the way, that's taxable. You have to pay tax on $15,000. And you'd have to have $1 million to make $15,000 a year. That's the predicament, because the stuff that's paying more than that, basically they're stocks. Stocks fluctuate a lot. I mean, not a little bit. Stocks fluctuate a lot. So if you compare a 10-year Treasury, 10-year Treasury is paying 1.73. That means on $1 million it's paying $17,000. So that's pretty wild. Let's go back to that $100,000. $100,000, 65-year-old, and it's going to start taking the income next year. And I'm actually going to come back to this because I have a question, and I'm going to go to the phones right now. Len, are you there?
Yeah, hi.
Hey.
So I wanted to ask you about HSA accounts and whether you think that's a good investment, good deal, and what type of investment should I be putting the money in?
Well, that's a good question. I have one. I fund mine fully every year. I leave mine in money market. It's just a checking account, because if I need to use it, I need to know that it's going to be there. Now, what you could do is leave the amount that's in like a money market account for that HSA account just to cover 1 year's deductible. Okay, so if you have health insurance, find out what the maximum amount that you could have to pay is, the deductibles and copays, and just leave that in money market, because you don't want to put that in the stock market. I mean, the S&P dropped. The S&P's been down more than 50% 3 times in my lifetime. Okay, so if you had a problem and you were in the hospital and you got these big bills, and it came time to pay the bills, and you had the money invested in a stock fund, and it was worth half of what it was when you went into the hospital, that wouldn't be a good thing. that would be, yeah. So you want to figure out minimally, and I would probably keep 3 to 5 years worth of deductibles in the HSA in the money. It's not going to earn any interest, okay, but it's there for the emergencies in case you need it. So if you wanted to keep something like maybe 4 years, maybe anywhere between 3 and 5 years, I would keep in a money market. And then if you wanted to invest it in something else, well, that just get a diversified plan. I'd probably stick with high quality dividend paying exchange traded funds. I don't think that's something that you can do in individual stocks right now. You might be able to, I don't know. But if you had the option, a lot of them don't have that option. A lot of the HSAs are just, savings accounts. So if you have the option, then I would probably stick with high quality dividend stock funds. And there are a couple of them that are out there. If you want to hit me up, send me an email, I can shoot you over some information on it. But they're ones that I'm just very fond of because I understand the investment process that they go through, and I like it a lot. So I use it in a portion of the money that I'm managing. So
Yeah, can HSA be used to pay Medicare premiums?
you know what? I am not a health insurance or HSA expert. I don't know. So I would actually have to. There's a person that I call for that. I refer people to them all the time, and that's another thing. I don't have his permission to use his name on the air, but again, that's something else I could refer you to him as well. And he's a specialist and lives right here in Richfield. So see, he can answer that question for you. So
Got it. Okay. Yeah. Thanks very much. You answered my question. Thank you.
All right. Well, thank you. Have a good day. That's funny how that falls back on what we started off talking about at the beginning of the program. A financial advisor, typically registered investment advisor, is really our vocation is the investment world. We have to be associated with a lot of the other stuff, and oftentimes people think that we should be doing taxes or health savings accounts, and that actually doesn't fall. That gives tax advice, and we're not allowed to do that. You have to have the license for that now. And this is really funny. I ordered a kit for beginning income tax preparers. The beginning income tax preparers. This book is 2,200 pages. 2,200 pages, and it's 10-point font. I measured. That means smaller than normal type that you see most newspapers, or a lot of newspapers. And I'm going, you have got to be kidding. By the way, there was a huge section in there on HSAs. I think it was about 35 pages. So, yeah. See, that to me, I can remember way back when I was in college. I kept thinking, this is obscene. The tax code, I took the income tax accounting class when I was in college. By the way, it changes about 15 to 20% a year. So after 3 years, you're lost. You're starting over, except that you're familiar with it. But anyway, it changes so much that I just didn't want to try to keep up with it. And so I know enough to know when I need to refer you to somebody else. And that's basically what most MDs are. You go to MD, as a general practitioner, he's going to say, okay, you're having problems with your ear, nose, and throat. Well, I'm not going to send you to a podiatrist. Yeah, I'm going to send you to somebody who actually specializes in that area. And that's what it's come to in our industry. It's and I don't mind. I mean, and it is kind of interesting reading through some of that stuff. And I've looked into a lot of this stuff for clients. And, the rules change just about every year. That's the other thing. Informed consent. That's a new phrase that it's been around for a while, but it has more meaning to me lately than it ever has. Informed consent. That means when you're doing research, you're saying, okay, this is what I know. Here's where I got the information. Here's what it seems to be saying. Now here's the name of someone who specializes in that area. So to do the A+ job, you need to call him and verify, because this is really out of my field. And quite frankly, we're not allowed to answer a lot of those questions. So I can tell you that informed consent, I'm informing you that, hey, this is not my bailiwick. It's not what I do. And you're consenting that you know that, that I'm not a specialist in those areas. So I can't imagine spending my life reading the Internal Revenue Code. Yeah, I know there are a lot of people that really like it. Thank goodness, because I've got a couple of acquaintances. Can't even speak this morning. I have a couple of buddies that specialize in those fields, and thank goodness for them, because you really need that today. Anyway, so we're talking about the income. So if you're looking at $100,000 and you're looking at short-term bonds, let's say 1 or 2 years, they're paying less than 1% right now, and that's not a lot. 1% on $1 million, 1% on $100,000 is $1,000. It's $1,000 a year, a little over $80 a month. And we're going to have to wait until we get back from these commercial messages to finish this thought up. You're listening to Bill Bullington right here on 1420. Stay tuned. I'll be right back.
Gotta keep breathing when the negative is all you hear. Gotta keep believing.
And we're back. Hey, this is Bill Bullington. I'm here every Saturday morning. You can go to my website if you'd like to talk more about some of the stuff that we're talking about. I think it's interesting today how many different things there are. The number of investment choices have just blown up substantially. So it's a lot to think about. Anyway, so if you'd like some help there, just feel free to give us a call. We've got the really quick retirement plan. You want to see if you're on pace. I know there are a lot of calculators out there online. Some of them can get kind of confusing at times. And the other thing that I really that kind of bothers me is when you start seeing the assumptions on the returns on some of the software. That oh man, it's just when you put in a 10% average annual return, that's not going to come without a significant amount of risk. I mean, it's a lot. I can't believe it. I can't believe how much risk there is on a government bond with interest rates as low as they are now. They've crept up. Interest rates have crept up, so bond prices have been dropping, and I don't think that's going to end anytime real soon. If you are within 10 years of retirement, you might want to be taking a really hard look at what your asset allocation is. I hate to see the same thing happen that happened in 2007, 2008, 2009. Okay, the market peaked in November of 2007, and by March of 2009, it was down over 50%. The vast majority of stock funds were down more than 50% during that time period. So if you're planning on retirement, or if you're already retired and you're taking money out, that's a problem. And by the way, bonds, the alternative, the thing that you use to try to buffer against the volatility, they fluctuated too. They weren't down as much, but you had a lot of high quality A-rated bonds that were down 14, 15% or so. And bond funds that were holding AAA rated short-term bonds, and they were down, in the mid-teens. So that's one of the risks that you got to be aware of. One of the solutions to that, I think, is a fixed indexed annuity. I didn't like these products before, but now that interest rates are so low, they make a lot more sense. And I was starting to talk about somebody who was going to be retiring at 66. He's 65 now. He's going to be taking income from it, so he puts $100,000 in, and a year from now, when he can turn the income on, he's going to get $5,803 a year. It's so funny when I say that. A lot of people go, "You mean a month?" Of $1,500 a month from $100,000? No, that ain't going to happen. But anyway, so if you divide that by the percentage that you started with, you start with 100, but it's a year. It's not super accurate. But anyway, so I'll just skip it. It's $5,803. And if you'd like to see this website where I got that information from, if you'd like to put your own numbers in there and kind of play around with it, again, send me an email and I'll be glad to get that back to you. But what I really like about this one too is if you put off taking the income from it, so you don't need the income for another 5 years. Well, that same person that started off with $100,000, 2, 3, 4, 5 years from now, the guarantee goes to $7,945. That's almost 8%. That's pretty good. 8% on what you originally started with. It doesn't count compounding and and all that other stuff. So probably shouldn't have even said that now that I talk about it. But there is a schedule online there. The more you delay taking it, the higher it goes. So it's kind of like Social Security in that if you don't take it right away, it'll go up each year. And this one's a schedule, so it's based on a schedule, and you can see what that schedule is. If you have any interest in that whatsoever, I think it makes sense for an awful lot of people, especially people that are on fixed incomes and looking for alternatives in that area. I think this one makes a lot of sense to consider. And which brings me to one last point before I start talking about stocks, the individual stocks, is, as a fiduciary, we're required to do what's in your best interest. I just want you to know that. And doesn't matter. I treated my clients that way long before that came a law, before it became a law. But now when you're a registered investment advisor representative, and you own a registered investment advisor firm, it's law. You have to operate in your client's best interests. So just thought I'd throw that out there. And again, if you hear anything that you'd like more information on, just go to my website, bullingtoncapital.com. There's a form on there, online form. You can fill it out. And make sure you write the question in, by the way. Because I get this a lot. People put their name and email, and then they forget to write the question. So it just speeds the process up a little bit. And okay, so we're going to talk a little bit about individual stocks. This is something I've always done. I have a small portion of my money, and this is the same thing I recommend to clients. Unless you have an enormous amount of time, you've got to have a lot of training, and you've got to have a stomach for risk. Managing individual stocks is not an easy thing to do. It's extremely difficult. So, having said that, here's the list that came up. One of the lists from the last time I ran my scan. And I thought there's some pretty interesting looking stuff here. There's a company, I don't know what this company does. I just think Fathom Digital Manufacturing Corporation. I have no idea. It looks like they came public not too long ago, and the shares started actively trading somewhere around mid-December. Thing goes from $10 down to $5. Now it's back to $10.24. That's really volatile. But the chart on it looks pretty good. And the symbol is FATF. And I don't even know what they do, because it just came up on this scan, and I'll have to look that up later. I just like the look of the chart. And if you go to, I'll publish these rules again at some point in time. I never, when I'm going to trade a stock, I'm considered to be a long-term trader, which is kind of an oxymoron. It means I'm not going to be day trading or holding on to it for a few days. I'm hoping that every stock I buy is going to go up a lot, and that I'll be hanging on to it for several months, or maybe a year or longer. So this is not long-term investing. This is, I guess the best way to call it is intermediate term trading. So it's an intermediate term. It's not long-term, but it's not short-term either. It's like in the middle there. And that's where I like to be. One of these days, if they ever get our new office built out, we're supposed to be out in November of last year. So if that ever gets done, we'll start doing some meetings on this again, and it's a lot of fun. And here's the one that looks kind of interesting to me. It's called Nexstar, Nexstar Media Group. Looks like it's a broadcaster. The NXST is a symbol. The price is $158.42. I'll come back to that in a second, because no, never mind. Yeah, I thought I was going to have a phone call. And if you'd like to call me, 216-901-0945, we have a few minutes here left. And if you'd like to reach me in my office, you can go to my website, bullingtoncapital.com, or 330-664-0700, 330-664-0700. And I'd be glad to try to help you out any way I can. And so there's not a lot of stocks that came up on the scan. And if you notice what's been going on in the stock market, not around 4 or 5% or so in the last week or so, that's really normal. That's extremely normal. So the fact that there were only 18 stocks that came up on the scan, that's kind of a low number. And that would just kind of confirm what we're seeing right now in the market as far as the individual stocks go. The vast majority of them are not breaking out to new highs. That'd be highly unusual if you had a couple hundred stocks making a scan when the market was in what could be a correction mode, and which brings me back to the same comment that I never finished the story of the young guy who's was being told that the stock market averages 10% a year, and the way that it was explained to him, it was 10% like it was interest on a CD. So I'm going, wow, no, that's actually not how it works. The 10% number, depending on when you start counting, can be pretty accurate. But if you started, at the wrong time, no way. Here, let me pull this up. I'm going to. I love doing this, by the way. People need to know. That's my biggest. I guess one of the biggest. I don't know what to call it. It's just something I really feel strongly about. That if you're going to be in stocks, and here you are in March of 2000, and you're going to buy the S&P 500 ETF back at that time, you'd have paid $150 for it. It got as high as $150, and then here you are, 3 years later. It actually the bottom was actually hit near the end of 2003. It went up a little bit and then came back down. Didn't go quite as low, but it was down 50%. 50% over nearly 3 years. That's painful. So avoiding that is kind of a big deal. If you want to learn how, hit me up, bullingtoncapital.com. This is Bill Bullington here every Saturday morning from 11 to noon. Have a good weekend, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.